Hey friends, welcome to this week's Mortgage Brief. This is where we take the headlines, the policy changes, the economic noise, and turn it into what it actually means for you, your mortgage, and your decisions. This week's theme isn't really about rates moving, it's about something deeper. The housing market feels slow. Qualification feels harder. And many Canadians feel like they're stuck, even though prices have softened. So let's talk about what's really happening. One of the biggest conversations this week came from OSFI, Canada's banking regulator, talking about loan to income limits and the mortgage stress test. In simple terms, regulators are intentionally trying to prevent Canadians from taking on too much debt relative to their income. And right now, they're saying these limits aren't actively restricting lenders yet, but they're designed to step in if borrowing power starts rising again. It's not an accident, it's the point. After the ultra low rate environment during the pandemic, borrowing capacity exploded and home prices followed quickly. Regulators don't want to see that happen again. So today's tighter qualification environment isn't a glitch in the system. It's a feature designed to protect long-term stability. And from a system perspective, it makes sense. But from a borrower perspective, it can feel very different because while policy is focused on stability, many Canadians are experiencing something closer to restriction. We're seeing a slowing housing market across the country. Sales are down, inventory is rising, confidence is shaky. And at the exact same time, qualifying for financing still feels difficult, even for well qualified borrowers. It creates a strange environment where prices soften, but access doesn't necessarily improve. And that hesitation is freezing both buyers and sellers. There's another layer to this that doesn't get talked about enough: renewers. Some homeowners are facing significant payment increases, higher debt ratios, or loan to value challenges that limit their ability to switch lenders. In those situations, renewal becomes less of a choice and more of a necessity. It's not a system stability concern, it's a confidence and household cash flow concern. And when comparison shopping disappears, negotiating power can disappear with it. That's why proactive conversations before renewal matter more than ever. Now, here's where the big picture gets interesting. When housing slows and borrowing is restricted, builders also slow down. Projects get delayed, margins shrink, financing becomes harder. Developers wait for clearer demand. So while today feels like a softer housing market, we may also be quietly reducing future supply. Historically, that combination, slower building during uncertain periods, can set the stage for tighter inventory and upward pressure a few years down the road. Not guaranteed, but very possible, which means today's slower market isn't necessarily solving the housing imbalance. It may just be reshaping the timing of it. So, what does all this mean for you? It means this market isn't broken, it's cautious. Regulators are prioritizing stability, borrowers are prioritizing certainty, and builders are prioritizing viability. And when everyone is cautious at the same time, the market feels stuck. But inside that environment, there is still opportunity, less competition, more negotiating room, more time to make thoughtful decisions instead of reactive ones. And sometimes Quieter markets are where the best long term decisions are made. As always, your mortgage strategy shouldn't be based on headlines. It should be based on your timeline, your comfort level, and your long term goals. If you're approaching renewal, thinking about buying, or just trying to understand how these policy decisions impact your situation, having a conversation early can make a big difference. Thank you so much for being here. I'll see you next week.